Hello everybody, welcome to On the Edge with Enza. Today I'm going to talk about Federal Reserve's decision to keep interest rates unchanged, about employment report in the US, about crypto market. I will also touch earnings of some magnificent seven companies. I will talk about gold prices, about luxury good prices, as well about home affordability in the US. Federal Reserve is maintaining its key interest rate, aiming for greater confidence in inflation trending towards 2%. Cryptocurrencies like Bitcoin and Ethereum have seen slight declines, with minor increases in the past hour last Friday. Market uncertainty persists due to fears of ongoing inflation and legal issues concerning Ethereum's status in the US. Crypto market may grow with the rise of real-world asset tokenization, showing 60% increase in total value locked since February 2024. The total value locked of these that-based investment protocols have reached around 8 billion US dollars, and these protocols include commodities, securities, and real estate tokenization. Powell, Fed chair, praised the progress in reducing inflation over the course of 1.5 years, but admitted recent stagnation in this progress. He indicated that rate cuts are unlikely soon, with potential rate cuts expected later in the year. The traders are expecting rate cuts in September this year, while I can see more later in December this year. Fed will also slow down the shrinking of its balance sheet starting in June. The employment situation report shows a less than expected increase in non-farm payroll employment by 175,000 in April. The unemployment rate rose slightly to 3.9%, with notable job growth in the sectors like healthcare, transportation, warehousing, social assistance sector as well. So average hourly earnings increased marginally, indicating annual growth of 3.9%. When it comes to earnings, Amazon Web Services leads the global cloud infrastructure market with 31% share, followed by Microsoft Azure at 25% and Google at 19%. The cloud sector spending increased by 21% from the previous year, with projections of market doubling in size over the course of 4 years. Luxury goods prices in Europe have surged by 51% since 2019, attributed to pandemic-induced inflation, as well strategic pricing to boost revenue and profit. Luxury market faces challenges as consumers become more price conscious and are demanding value for the money they are paying. For example, Chanel medium-size flap bag costs 11,100 euros. This year, it is a 91% increase in price since October 2019. So consumer price index rose 3.5% in March this year, driven by shelter and energy costs. Consumer confidence is waning, with concerns over job security and income affecting discretionary spending. For example, McDonald's and Darden, Starbucks as well, reported weaker than expected earnings, reflecting a pullback in consumer spending. So seasonality suggests lower performance for the consumer discretionary sector in May and June will follow. Chinese speculators are impacting the gold market. US large cap stocks outperformed the small caps because small caps are affected by higher interest rates for longer period of time. Gold trading in Shanghai is influencing prices, with gold reaching a record high of 2,431 US dollar per ounce. So this interest in gold as a safe haven asset has surged, particularly in Asia, and people in China are using gold to protect their money. They are moving away from real estate assets as well stocks. The big interest in gold in Asia is a new trend which we should watch, and is very important indicator of how people are concerned about the well-being of economy. Netflix achieved record revenue of 9.4 billion in the first quarter of 2024, and that's 14.8% increase year over year, with the net income soaring to 2.33 billion, up 79% year over year. Despite this, the stock fell 9% post-earnings report due to overly optimistic expectations and the announcement that subscriber numbers will not be reported starting first quarter 2025. Tesla is planning also to lay off 10% of its workforce, which would still mark 163% increase in employee count since late 2019. The company's shares rose by 12% following the announcement of affordable EV models set to start production by early 2025, despite 9% drop in first quarter revenue, the biggest drop since 2019. Meta Platforms reported 27% increase in revenue, doubling of net income in the first quarter. However, the stock declined by 16% due to conservative revenue projections for second quarter of this year and heavy investments in mixed reality and AI. US existing home sales have been declining year over year for 31 consecutive months, the longest down streak since 2007-2009 period. Mortgage rates have risen to 7.1%, with affordability issues impacting both demand and supply. The monthly mortgage payments needed to afford a median home in the US has increased 88% over the last 4 years, from 1,480 US dollars per month to 2,780 US dollars, and the purchasing power fell by 35% over the last 4 years. The private credit market has grown significantly, with the direct middle market lending increasing by 600% since 2008. Over 72% of this market is sponsored by private equity, and 81% of credit funds are managed by firms that handle private equity funds as well. Over 71% of this market is sponsored by private equity, and 81% of private credit funds are managed by firms that handle private equity funds. The US dollar is in the phase of consolidation after strong performance amid geopolitical tensions in the Middle East. Higher interest rates, job market concerns, persistent inflation, tightening in consumer spending are likely to affect consumer discretionary stocks, with potential implication also for broader market and economy. Sticky inflation, renewed uncertainty about the timing of Federal Reserve's interest rates cuts, and noted the likelihood of no lending scenario in which growth and interest rates remain largely unchanged. This also elevated credit risk for rate-sensitive asset classes. Thank you for watching me today. I hope you enjoyed. Please press subscribe button, like, comment. Bye.